There's a professor most of the financial world has never heard of. He doesn't work at Goldman Sachs. He doesn't have a Bloomberg terminal. He has never managed a hedge fund or appeared on CNBC to tell you whether to buy or sell. What he has done, with a precision that has repeatedly made geopolitical analysts look like they were reading yesterday's newspaper, is use geography to predict the collapse of empires. His name is Professor Jiang Xueqin, and his framework for understanding how great powers destroy themselves by getting trapped in geography is the most useful lens for understanding what is happening to the United States right now. Now, the question this video exists to answer is not whether Professor Jiang is right. The question is, if he is right, if the US is genuinely entering the terminal phase of imperial overextension, what does that mean for Bitcoin? Because there's a direct, mechanical, and largely ignored connection between the collapse of US imperial monetary dominance and the price of a fixed supply digital asset that exists outside every empire's jurisdiction. The connection runs through liquidity, through the dollar, through the debt machine, and through a set of dynamics that most Bitcoin analysis, fixated on halvings and ETF flows, has completely missed. This is that connection explained. And by the end of this video, you will understand why, if Professor Jiang Xueqin's analysis of US empire collapse is even partially correct, Bitcoin does not go up. Bitcoin goes nuclear. Before we get into the mechanics, you need to understand why Professor Jiang Xueqin's framework matters for a macro finance channel. Jiang Xueqin is an independent scholar, educator, and geopolitical analyst. His work sits at the intersection of historical pattern recognition, game theory, and what he calls predictive history, the use of deep historical cycles to forecast near-term geopolitical moves with a level of specificity that conventional analysts avoid because specificity creates accountability. His most viral piece of analysis, which we covered in this channel's series on the US-Iran conflict, is what he calls the Iran trap, how geography destroys superpowers. The argument is precise. The United States military doctrine of shock and awe has a fatal flaw when deployed against an adversary whose strategic value lies not in its cities or infrastructure, but in its geography. Iran does not need to win a single conventional battle. It needs to survive long enough for the geography to do its work. World War III and the failure of American shock and awe. That is the analytical frame, not a prediction of apocalypse, a mechanical analysis of how a specific imperial strategy fails against a specific geographic and economic opponent. Why does this matter for a Bitcoin and macroeconomics channel? Because the mechanism by which US imperial overextension destroys itself is monetary. It is the dollar. It is the debt machine that funds the military that enforces the dollar's global role. It is the petrodollar recycling system that requires the Strait of Hormuz to remain open. And it is the global liquidity regime that Bitcoin sits at the very tip of, absorbing every impulse, both inflationary and deflationary, that the imperial monetary system generates. Professor Jiang Xueqin is not a Bitcoin analyst, but his framework, applied to the monetary consequences of imperial collapse, produces a Bitcoin thesis that is more structurally compelling than anything the crypto community has generated internally. That is what this video builds. Let's go inside Professor Jiang's Iran trap analysis because the mechanism matters. Iran does not need a single missile to collapse the American empire. That is not a provocative headline. It is a structural argument. Here is how it works. The United States projects military power through carrier strike groups. Those carrier groups require fuel, supply chains, and the ability to operate in confined waters. The Persian Gulf is a confined water. The Strait of Hormuz, at its narrowest point, is approximately 33 kilometers wide. Through that strait passes approximately 20% of the world's traded oil and roughly 35% of the world's liquefied natural gas. Iran's strategy, as Jiang Xueqin has documented in detail, does not require conventional military victory. It requires making the strait operationally dangerous for long enough to destroy the insurance and hedging markets that make global oil trade possible. Iran's $50,000 drones, a fraction of the cost of the systems required to intercept them, can be deployed in sufficient quantity to threaten tanker traffic without engaging U.S. carrier groups directly. The economic asymmetry is catastrophic for the United States. More importantly, the moment the strait closes, even temporarily, oil prices spike. When oil prices spike, the petrodollar recycling mechanism, the system by which oil exporting nations earn dollars and reinvest those dollars into U.S. treasuries, comes under severe stress. Saudi Arabia does not increase its treasury holdings. It diversifies. It buys gold. It considers UN-denominated contracts. The U.S. dollar's role as the world's reserve currency does not collapse in a day. It corrodes over the course of a conflict. Why America amplifies nuclear threats to survive, as Professor Jiang has argued, is precisely because conventional military victory against Iran is not available. Nuclear signaling is the last leverage point of a power that cannot win on the ground, cannot sustain the economic cost of a prolonged conflict, and cannot afford the monetary consequences of a closed Strait of Hormuz. This is not pessimism. This is game theory applied to geography, applied to financial markets. And the financial market that responds fastest to dollar credibility stress is not gold. It is not the euro. It is Bitcoin, the fixed supply, jurisdiction-free asset that exists precisely because someone, 15 years ago, decided to build a monetary system that no empire could control. To understand why U.S. imperial overextension breaks Bitcoin loose from its current constraints, you need to understand exactly how the dollar machine works and where it is most fragile. The dollar's global dominance rests on 3 pillars, not one. The first pillar is Bretton Woods' legacy. The dollar became the world's reserve currency in 1944 because the U.S. emerged from World War II as the only major economy with its industrial base intact. Every other currency was tied to the dollar. The dollar was tied to gold. This gave the U.S. what French economist Valéry Giscard d'Estaing called its exorbitant privilege. The second pillar is the petrodollar. After Nixon ended dollar-gold convertibility in 1971, the dollar needed a new anchor. The 1973 to 1974 deal with Saudi Arabia, oil priced in dollars, U.S. military protection in exchange, created structural and global demand for dollars. Every country that imports oil needs dollars. Every country that needs dollars must hold dollar-denominated assets. The demand for U.S. treasuries is not a market phenomenon. It is a geopolitical construct. The third pillar, and the most fragile, is confidence. The dollar is a fiat currency. Its value is ultimately backed by the belief that the United States will honor its obligations, maintain institutional stability, and retain the military capability to enforce the rules-based international order that makes dollar dominance self-reinforcing. Professor Zheng's framework attacks the third pillar directly. If the U.S. military demonstrably fails to achieve its objectives in a major conflict, if the failure of American shock and awe becomes a broadcast fact, the confidence pillar weakens, not catastrophically, not overnight, but in the way that actually matters for financial markets, at the margin, in the risk premium, in the rate at which foreign central banks reduce their dollar reserve holdings. When foreign central banks reduce dollar reserves, they sell treasuries. When they sell treasuries, U.S. borrowing costs rise. When U.S. borrowing costs rise on a $38 trillion debt load, currently costing over $1 trillion annually in interest payments, the fiscal math becomes catastrophic. The Federal Reserve's response has a name. It is called quantitative easing. More QE, more liquidity, more dollars into the global financial system. And every dollar that enters the global financial system searching for a store of value in a world where the dollar's own credibility is in question makes the case for Bitcoin stronger. This is the mechanism. It does not require empire collapse. It requires only the beginning of doubt. Here is where we need to be precise about the word liquidity, because it means different things to different audiences watching this video. If you come from the trading world, if you study smart money concepts, ICT methodology, draw on liquidity, sell-side liquidity, and buy-side liquidity, you have a definition of liquidity that operates at the microstructure level. Price hunting for resting orders, engineered liquidity sweeps before reversal, institutional order flow mechanics. That is a real phenomenon. But it is not the liquidity we are connecting to Professor Jiang Xueqin's empire analysis today. Macro liquidity is the flow of money through global financial markets. The money moving through repo markets, through central bank reserve creation, through the pipes that connect monetary policy decisions to asset prices across every market on Earth. As of 2025, the Global Liquidity Index tracked by Dr. Michael Howell of Cross Border Capital across nearly 90 countries, approximately $190 trillion in financial flows, is the single number that best predicts Bitcoin's price direction with a lag of 8 to 13 weeks. The correlation between global M2 growth and Bitcoin price appreciation runs to 0.78 in the 2020-2023 period. Coinbase Institutional's liquidity tracking framework finds correlations approaching 0.9 across most time horizons. Bitcoin is the most liquidity-sensitive asset on the planet. Now connect that to Jiang's framework. Every phase of U.S. imperial stress, military failure, dollar credibility erosion, foreign treasury selling, forces the Federal Reserve toward one response: more liquidity, more asset purchases, more reserve creation, more quantitative easing. The Iran trap is not just a military trap. It is a liquidity trap. The U.S. cannot sustain a prolonged conflict without monetizing the cost. And every dollar of monetized conflict cost is a dollar that enters the global financial system, searching for hard assets with fixed supply. There are approximately 21 million Bitcoin, fixed, forever. Let us look at the historical record that Jiang Xueqin's predictive history framework draws on, because the pattern is not subtle. Every major imperial power that overextended militarily has faced the same monetary sequence. Rome debased its currency to fund its legions until the denarius contained almost no silver. Spain extracted the silver of the Americas and watched inflation destroy the productive economy it was supposed to finance. The British Empire, after World War I and World War II, found its military commitments unsustainable and its currency progressively replaced as the world's reserve by the dollar. In each case, the sequence was identical. Military overextension generates fiscal stress generates monetary expansion generates inflation erodes the currency's credibility as a store of value. Hard assets appreciate. The difference today is the speed and the tools available. When the Roman denarius was debased, people hoarded gold and silver coins. The process took generations. When the British pound lost its reserve status, the transition took decades. Bitcoin compresses that timeline dramatically. It is globally accessible in seconds. It requires no physical custody. It has no geographic jurisdiction. It cannot be confiscated by a government that doesn't control the private keys. And its supply cannot be increased by a central bank under fiscal pressure. When Professor Jiang Xueqin argues that the U.S. could be trapped in Iran, that the failure of American shock and awe creates a military, political, economic doom loop, he is describing, in geopolitical language, the precise conditions under which the historical hard asset trade plays out. Gold benefits. Bitcoin, for the first time in history, also benefits, and benefits faster, more accessibly, and with more asymmetric upside than any hard asset that has existed in prior imperial transitions. This is not a Bitcoin maximalist argument. It is an application of Zhang's predictive history methodology to the monetary consequences of what he is describing. Before we get into the exact math of the $38 trillion debt wall, I want to take a very quick pause. If you are still watching this breakdown right now, you are officially in a very small and elite minority. The vast majority of the internet is completely distracted by short attention spans, but the fact that you have made it this deep into a complex macroeconomic analysis proves you possess the rare focus and discipline required to actually understand how global markets move. Because we are discussing global geography today, I would love to know exactly who is in our community. Please drop a quick comment below with your city, your local time, and what the weather looks like outside your window. Honestly, reading your comments and seeing the global intelligence of the engineered markets community is genuinely one of my absolute favorite parts of producing these deep dives. While you are leaving that comment, please take 1 second to hit that like button and make sure you are subscribed to the channel. Your support tells the algorithm that you value serious financial research, and it helps us build the sharpest community on YouTube. Let me know where you are watching from, and let's get right back to the debt wall. Here is the number that makes Professor Zhang's geopolitical scenario a near certainty for monetary expansion, regardless of whether the U.S. wins or loses any specific military confrontation. The United States currently carries $38 trillion in federal debt, 121% of GDP. Interest payments exceed $1 trillion annually, more than the defense budget, more than Medicare, more than any other single line item in the federal government's accounts. By 2030, the Congressional Budget Office projects that federal debt interest payments will exceed $2 trillion annually. By mid-century, debt to GDP approaches 250% in the baseline scenario. Now add a major military conflict. World War II cost the United States approximately $4 trillion in today's money, financed primarily through war bonds and Federal Reserve monetization. A prolonged conflict in the Persian Gulf, one that does not achieve rapid victory because, as Zhang argues, rapid victory is not achievable, would run into the trillions annually in direct costs, plus elevated oil prices flowing through the entire economy, plus disrupted global trade. The Federal Reserve's response to a fiscal crisis of that magnitude is not ambiguous. It has one tool that actually works at scale: quantitative easing, balance sheet expansion. Whatever name you want to use for the process of creating dollars to buy the bonds that fund the spending that the tax base cannot support. In 2008, the Fed's balance sheet was under $1 trillion. In 2022, it touched $9 trillion. The 2020 COVID expansion alone added nearly $5 trillion in 2 years. A major geopolitical conflict on top of the existing debt structure would dwarf all prior episodes. And every prior episode of that scale has been followed by a Bitcoin bull run. Not because Bitcoin is a war trade, because Bitcoin is a monetary expansion trade, and war is the most historically reliable driver of monetary expansion. The Bitcoin cycle, in this scenario, is not driven by the halving. It is driven by the fiscal response to imperial overextension. Professor Zhang maps the geopolitical trigger. The debt structure provides the monetary mechanism. Bitcoin sits at the end of that chain. There's a second-order effect of Professor Jiang's scenario that most financial analysts are not pricing, because most financial analysts are not connecting geopolitical fragility to monetary architecture. If Iran successfully disrupts oil flows through the Strait of Hormuz, even temporarily, even partially, the petrodollar recycling system comes under acute stress. The petrodollar system works because oil exporters earn dollars and reinvest those dollars into U.S. treasuries. This creates structural demand for dollars and keeps U.S. borrowing costs artificially low relative to what a $38 trillion debtor would otherwise face. When that recycling breaks, when Gulf states begin pricing oil in alternative currencies, accumulating gold and Bitcoin reserves and reducing their treasury holdings, the structural demand for dollars falls. The Federal Reserve must step in as buyer of last resort. That means more printed dollars, more liquidity, more balance sheet expansion. But here's the specific Bitcoin connection that almost nobody is making. Several Gulf sovereign wealth funds have already begun exploring Bitcoin as a reserve asset. Abu Dhabi's Mubadala has publicly disclosed Bitcoin ETF holdings. Saudi Arabia has been reported in financial intelligence circles as exploring digital asset exposure as a diversification tool in a world where the petrodollar's longevity is in question. These are not ideological positions. These are sovereign wealth management decisions made by people who understand that if the petrodollar system is under structural stress, and Professor Zhang's analysis suggests it is, then holding dollar-denominated assets as the primary reserve is precisely the wrong position. Gold and Bitcoin, in a post-petrodollar world, are not the same trade. Gold is the institutional trade, the asset that central banks and sovereign wealth funds know how to custody, audit, and report. Bitcoin is the asymmetric trade, the asset with fixed supply, zero custody friction through ETFs, and price behavior that reflects global monetary expansion more sensitively than any other instrument. In a scenario where the petrodollar system fragments, even partially, even slowly, both trades work. Bitcoin's works harder. The trading community has a concept called smart money. Large institutional players that engineer liquidity sweeps, moving price to take out retail stops before reversing in the true direction. The smart money concept says, don't follow the retail narrative. Follow the institutional order flow. At the geopolitical scale, the same logic applies with devastating precision. While retail investors in Western markets were watching Bitcoin's price and debating halving cycles, while the crypto media was focused on ETF flows and Michael Saylor's latest Bitcoin purchase, a different set of actors was making sovereign-level asset allocation decisions driven by exactly the geopolitical analysis that Professor Jiang Xueqin has been publishing. China has been accumulating gold at a pace that has set records for 3 consecutive years. Russia moved the majority of its sovereign reserves into gold and yuan-denominated assets before 2022. Iran, despite being under the most comprehensive financial sanctions regime in history, has developed Bitcoin mining operations as a mechanism to convert stranded energy assets into a globally liquid, sanctions-resistant store of value. These are not retail Bitcoin investors making speculative bets on the Bitcoin price prediction cycle. These are sovereign actors making strategic decisions about how to hold value in a world where the US dollar's role as the neutral reserve currency is being actively contested. The smart money in the geopolitical context was positioning years before the scenario became consensus. That is always how it works. The question for the viewer of this video is not whether to believe Professor Zhang's framework. The question is, at what point does the retail investor recognize the institutional positioning that has already occurred? And at what point does that recognition create the Bitcoin bull run that makes the prior positioning look prescient? Let us be precise about what Bitcoin goes nuclear actually means, and what it does not mean. It does not mean Bitcoin goes to infinity immediately. It does not mean the US dollar collapses next year. It does not mean Professor Jiang's scenario plays out exactly as he has described it. What it means is this: there exists a scenario, in which Jiang's framework argues is not only possible, but historically overdetermined, in which the following events occur in sequence. U.S. military engagement in the Persian Gulf fails to achieve rapid, decisive victory. The Strait of Hormuz faces extended operational disruption. Oil prices spike. The petrodollar recycling mechanism comes under stress. Foreign central banks reduce treasury holdings. U.S. borrowing costs rise. The Federal Reserve responds with significant balance sheet expansion. Global liquidity expands dramatically. Bitcoin, as the most liquidity-sensitive asset on the planet with a fixed supply of 21 million coins, absorbs a disproportionate share of that liquidity impulse. In that scenario, Bitcoin's price behavior is not driven by the halving cycle. It is not driven by BlackRock's ETF inflows or Michael Saylor's Bitcoin purchases. It is driven by the largest forced monetary expansion in the history of the United States, triggered not by policy choice, but by the structural impossibility of financing imperial overextension with a currency that is already stretched to its limits. Quantitative finance models that have tracked Bitcoin's correlation to global M2 growth at 0.78 to 0.9 suggest that a doubling of the Fed's balance sheet from current levels, roughly from 6.5 trillion to 13 trillion, would, based on historical relationships, produce Bitcoin price appreciation of a magnitude that makes the 2020-2021 Bitcoin bull run look modest. The 2020-2021 cycle took Bitcoin from $5,000 to $69,000 on the back of a $5 trillion Fed balance sheet expansion. A geopolitically driven expansion of comparable or greater magnitude hitting a Bitcoin market with BlackRock ETF infrastructure, MicroStrategy's balance sheet, sovereign wealth fund exposure, and a fixed supply already more concentrated in long-term holders than at any prior cycle peak. The mathematics are not subtle. This is not a Bitcoin price prediction. It is an analysis of the causal chain that Professor Jiang Xueqin's framework implies for a fixed supply monetary asset.